Today we want to look at final accounts for sole trader. We are going to start with the income statement. Then when we are done with the income statement, we shall look at the statement of financial position. The income statement is supposed to be prepared by any person in business, any entrepreneur who is engaged in business activities. Whether it's a marketeer, it's a carpenter, a bricklayer, metal fabricator, an agriculturalist, you are growing vegetables, you are supposed to prepare an income statement from the source documents. You prepare an income statement from the trial balance of your business. So there's no need for you to fear to say, no, the income statement is specifically for people in accounting. No, this is what we are trying to change. We want to change the narrative so that you understand the business, you understand what you are doing. So whether you're a bricklayer, you are supposed to prepare this. So today we want to look at the income statement. An income statement is a statement that is prepared in order to ascertain the profitability of your company, to ascertain the profitability of your undertakings, business undertaking, ascertain the profitability of your carpentry shop. So what we are going to look at, this is part one. We are going to look at the format of an income statement. Always, you start with the sales. You start with the sales for the period. An accounting period is usually 1 year. So you add all the sales for 1 year. So you write sales. Okay, so let us proceed and see what you are supposed to do as an entrepreneur. So the format is like this. Here you will have your sales. Okay, sales, you put your kwacha there. Then we are going to put another kwacha there and another kwacha there. This space is for adjustments, and this one. This space is for final figures. So our sales, you put your figure for sales here. Okay? If at all there are adjustments, then you proceed with your adjustments. And the adjustments that are associated with the sales are sales returns. So you write less. Sales returns. Okay? The figure comes there. When I say less, it means you subtract, because you have sold the goods and then they have been returned. That's why you say less. The answer that you get after subtracting comes here. You put it there. Then after this, if at all we have the opening inventory, then you add the opening inventory. So in this case, let's say we have opening inventory. So you say add opening inventory. To this figure, you add the opening inventory. Okay? When you add, you get this figure here. You have added this plus this. This is your net sales because we have lessened the returns. Then the next item that you need to look at are the purchases. So meaning you need to add the purchases. These are the goods that you have bought for resale during the period. So you add the purchases to this one. Okay? These purchases, if at all there are adjustments that you need to make, then the figure will not come straight here. It will come here so that you are able to do your adjustments. Once you are done with your adjustment, the final figure is the one that comes here. So let's say this question has adjustments. So you put it here. Okay? Usually the adjustments that are associated with purchases are purchases returns and the carriage inwards. So let's say we had purchases returns, so you less. Okay? You less the purchases returns. So when you subtract this from there, it will give you this figure. Okay? Then you look at the carriage inwards. If you are to carriage inwards, this is when you are helped or you use transport to carry the purchases from where you have ordered or where you got them, bringing to the business. Okay, so you are going to add to the purchases. So you say add purchases. The purchases carriage inwards. Okay, the figure comes there. So when you add the carriage in, the figure that we are going to get will come there. It will be under this one. So we have added here, then we get this figure. Okay? So this figure that we have gotten is called net purchases. This is net purchases. This is net purchases. Why? Because you have removed the purchases returns and you have also added the carriage inwards. Okay, so you move on. You continue with your journey. As an entrepreneur, don't fear these things. These are normal trends that you need to do in your business. Okay? So, we are now going to add this figure that we got here and this one. Okay? Our net purchases so that we get the cost of sales. So, you add these two. When you add the two, you are going to get the cost of sales. So this figure is cost of sales. This is the cost of sales. So to cost of sales, if you are the closing inventory, when the accounting period came to an end, still you are the closing inventory. You have to lessen the closing inventory. Okay, so we are going to say less closing inventory. So we are lessening the closing inventory from here. Okay? Once you lessen the closing inventory, okay, from your cost of sales, you subtract the closing inventory. The figure that you are going to get is the one that we call gross profit. So the gross profit figure comes this way. Okay? So our gross profit figure will be here. This is the gross profit. Alright, when you reach here, the journey has not yet ended. Why? Because there are certain gains that are associated with the gross profit. For example, if during the period, the accounting period, you received the commission, okay, you add to gross profit. If you had allowables, okay, you were allowed, or there was a discount that you received, okay, you received a discount as a company, it comes there. So to this one, you say add gains. Add gains here, okay? So you put it there. So when you add this and this, it will give you this figure. This is called adjusted gross profit. Adjusted gross profit. Okay, so this component from the sales up to adjusted gross profit is the one that formerly we used to call it trading. Here you are showing the activities that took place. Okay, so this is a trading account formerly. Then underneath we have not yet subtracted any expenses. Okay, so we used to have profit and loss account. So this is a trading account. Okay, previously that's the way we used to call them. This is a trading, what we have done is a trading account. So when you reach at this level, adjusted gross profit, you now look at the expenses. Okay, you say less expenses. So all the expenses will be subtracted from the gross profit. So what I wanted to show you today is the trading account that we used to call formerly. But now it's a joint statement which covers the trading account, it covers the profit and loss account. It's called income statement. Why? Because accounting is changing every day. So even the terms that we are using now have completely changed. So you as a sole trader, as a business person, as a carpenter, you can do this. You need to record all these things. And at the end of the year, you come up with such a document. Alright, see you next time when we are going to work out, we are going to attach the figures to our income statement. See you in the next video.